Hey, welcome back. SoFi, or social finance, is currently in a very interesting spot. Despite delivering massive growth and still having a lot of potential, the stock is close to some of the lowest prices ever. But with rate cuts on the horizon, there might be a catalyst that could unlock even more growth, so let's have a look. For a while, I said dividend stocks were probably the best thing to buy given the upcoming rate cuts and the lower prices, but now growth might become the next thing to buy. I looked into a bunch of them lately and there are quite a few that are getting to very interesting prices, including SoFi. I bought quite a bit of Realty Income, for example, at around a 6.5% yield, but now, after it went up and they pay around 5%, it isn't terrible, but it's much worse. We can see very impressive growth, adding another 640,000 new people in Q2, which is the second largest amount ever. They more than 8x'd the number of members from Q1 2020 and they still deliver very good growth even in this market, which is a huge achievement. And as a note, they are actually being cautious. You know, if they wanted to get growth at any cost, it's not really difficult in this industry, but getting quality and sustainable growth and new members is much better. They see a net income of around 180 million this year, marking the company's first year of positive net income. It's not a lot for an 8 billion market cap, but it can be the beginning and it's definitely something to watch. Something to keep in mind about the net income is that they see it at 180 million this year, but that's with about 250 million in stock-based compensation. Anyway, getting to 180 from a negative 300 a year ago is a huge improvement. The revenue has been slowing down lately, which is probably the main reason behind the market's pessimism. Again, a majority of the pandemic IPOs had huge expectations around them, and now when they reach a more mature stage and they don't deliver that 40-50% growth, the market doesn't want them anymore. But in the current environment with rate cuts, it's not impossible to see them keep delivering at least 15-20% growth, which can add up to a lot in, let's say, half a decade. If they switch the focus to profitability during this time, the net income can grow significantly. Right now, that's a margin of around 7.35% and a third of the net income is from extinguishment of debt in Q1, so there is a lot of room to improve. Now, the role of high interest rates is to slow down the economy. This monetary policy is one of the few traditional ways in which the government can fight inflation and unemployment together with a fiscal policy. As a parenthesis, we saw what not having this ability did especially to Greece and a few other European countries in the 2007 crisis. Since they adopted the euro, it wasn't their decision alone anymore, and we saw countries with 1-2% inflation during that time not wanting to pay the bill for other countries. Now, when the rate gets back to 0, 1, 2%, you'll see a lot more economic activity from people and companies. It's a huge difference in interest if you want to buy a car or a house, for example. So, on the one hand, SoFi would lose some demand from the 3, 4, 5% or whatever interest saving accounts, but potentially win much more from the volume in pretty much everything else. That means there is potential to see even better than the recent 640,000 new members. The financial services platform Galileo already accounts for about 45% of the revenue and they expect it to get to around 50 from 32 a couple of years ago. This can get an even bigger boost as rate cuts will very likely improve borrowing and spending activities. By the way, by Q2 this is the second raising guidance this year already with about 25% growth in EBITDA and a bit below 20 in revenue expected. Again, even at a 15-20% revenue growth rate, the net income can see much better growth if they focus on that, although in the future this might be a pretty tight margin industry. But to grow they can also look into Europe. We have tons of potential acquisition targets and Galileo is also something they bought. Financially, this can tell us quite a bit that we don't see in the media or even the company's presentations. First of all, taking the client-related things out, the company is in a very good position with enough cash and investments to cover the debt and other liabilities. There is about 5.9 billion in equity, which is huge for a fintech company valued at around 8. Even without the goodwill, this is a very nice ratio. Even PayPal, which is seen as undervalued by a majority of people, is at a price-to-book ratio of 3.5 to 4. Secondly, the debt went down significantly to around 3.1 billion from 5.2 at the end of last year, so this balance sheet improved quite a lot in such a short amount of time. It may not look like a lot, but 2.1 billion is the company's revenue in a year and 40% of the total debt. Plus, something that might generate future income is that the interest-bearing deposits, meaning what the clients have in their accounts, went up from 18.5 billion to almost 23 billion. That's an over 24% increase in 6 months. Now, a potential issue that I see people talk about is the amount of shares that they issue. They issued about 32.5% since the IPO in 2021, which is quite a bit of money. It isn't uncommon while they aren't profitable though. Other options would be very expensive debt or scaling down the business by selling assets, which would affect the revenue and the stock price probably more than the dilution. And again, they more than doubled the revenue from that time, net income is turning positive, EBITDA is growing very well, so even with such a level of dilution, it's technically below the company's growth. Now, the valuation is a bit uncertain because we don't really know how profitable this company can be. In a bad scenario, let's say they don't make anything or even lose money, which is not impossible with such high competition. This would be more about the revenue and the market's expectations, so let's assume a ratio of around 2, which should be, let's say, pessimistic. That's similar to Square or Block after they fell so much. So based on this year's expected revenue, that should be a market cap of around 4.9 billion. That's a price of 4.6, which is very close to the bottom we saw in 2023, for a roughly 36% loss. In this case, maybe if they cut some compensation and other costs, they could break even or make a bit of money, but it wouldn't be that good. Maybe a traditional bank could buy them because they have after all a lot of equity. Then with synergies, they could make it profitable, so thanks to the equity and the assets, there should be kind of a bottom that limits the downside unless they deteriorate significantly. In a second scenario, let's say they grow the revenue at 15% and reach a cash flow margin of 10%. This kind of margin is like half of what a normal bank typically has nowadays, so this is quite conservative. You know, not having physical locations with tens of employees saves a ton of money, so this type of business model is more efficient and could achieve much better margins. In 5 years, taking 2024 as a base, that's 4.92 billion in revenue, so 492 million in cash flows. For a ratio of 25, which I think is fair for a company growing at such ratios, that's a market cap of 12.3 billion. That's a price of 11.54, meaning a 50% profit, which is very similar to the IPO price. So that's below the company's growth, meaning that the market currently has higher expectations. In a good scenario, let's say they manage to expand and with the help of rate cuts, grow the revenue at around 18%. Keep in mind that this company has a very tiny market share out of the total banking sector, so they can theoretically grow like this for ages. For a margin of 15%, which is around the average of the sector during the economic cycle, that's 840 million in half a decade. For a ratio of 30, which is again pretty conservative for a fintech company growing like this, that's a market cap of 25.2 billion. That's a price of 23.64, meaning around a 3x. Again, even this can be seen as a pretty conservative assumption, but they still have to prove profitability, and this is an industry where giant companies as old as the US fight. If they become a, let's say, problem, a company like JP Morgan can easily afford to fix it. We had this independent online banking service here in Europe do very well, and now big banks are trying to catch up, launching their own sub-brands. And the banks in Europe in comparison are small caps versus American banks. So it shouldn't take much to see them do pretty well, similar to a few other companies that I'm very close to buying, which you can see in this video. Overall, I like the company and I think there is potential. I think rate cuts should be pretty beneficial because they would boost the economy and subsequently lead to a potentially higher demand for SoFi services. The thing with all the pandemic IPOs is that the market had extremely high expectations at the beginning, hence the original price. They were heavily promoted on every source of media you could find, and obviously all that demand led to a very high stock price. But now, with a majority of these companies, the market is getting a, let's say, wake-up call. That can lead to a potentially irrational amount of selling by people who just bought without researching, which can open opportunities. Because it's one thing to buy when you know nothing about what a company can do and something completely different now. Today, when they keep delivering very impressive growth and potentially nice profits, this is actually quite an interesting company, especially at this price. So this definitely has a lot of potential, and even if it may be less than what the market expects, they can still do quite well. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.